Before we start this week's podcast, I'd just like to say a quick thank you to our sponsor, Money Farm. Now, for those of you who don't know, Money Farm are one of the biggest digital wealth managers in the UK and Europe. They not only have a stocks and shares ISA, but they now have a pension which they can run for you. And now we've secured an exclusive deal for Money to the Masses podcast listeners and Money to the Masses readers, where Money Farm will reimburse the exit fees and dealing charges charged by your existing pension provider if you transfer to them. You can find out our view on Money Farm by going onto the moneytothemasses.com website and searching for Money Farm Pension Review, where you'll also find all the T's and C's. Now on with this week's show. Hello and welcome to episode 197 of the Money to the Masses podcast with me, Damien, your resident expert, and of course, no Andy Leaks, which you've probably guessed because I've done the intro. Now, Andy's away on holiday with his family, so we forgot about that actually last week and didn't inform you, but you've got me all to yourself this week. Before I carry on though, I just want to talk about the meetup. Now, last week, Andy and I discussed about the meetup we're going to do with Pete Matthew from the Meaningful Money podcast. Now, I can confirm that that is happening on Friday the 2nd of November 2018. So that's this Friday coming in London. Now, we're going to meet in a pub called the Cross Keys, which is cross with an E on the end, which is a pub near Liverpool Street. It's actually on Gracechurch Street in the City of London. Now, go to our Facebook page. All the details are on there and how you can come meet us. Now, don't just ignore that message. Please do come along, because it's nearly our 200th episode. You can meet Andy and me. You can meet Pete and a whole host of other people. I know you may be sitting there thinking, is it a bit weird for me to go and meet a guy on a podcast who I listen to? I'd love to meet you guys and possibly buy you a drink depending on how many people come. Don't necessarily assume that everybody else will come. It'll be great to meet you and it'll be good to chat to you about all sorts of things, money or whatever it is you want to talk about, and it'll be good fun. So if you've like what me and Andy have been doing all these years, please come support us. It's the first time we've ever done this and it should be fun. Now, usually I talk about what I've been up to and Andy have been up to this week. I won't do that, although the one thing I will say is that I did have a slightly bizarre viral video this week. If you follow me on social media, it's well worth it these days because we do a lot on social media. But I had a video that was probably viewed about 100,000 times. It was nothing to do with money, funnily enough. And I can tell you about that story if you come and meet me next week, as it was slightly worrying actually what happened. But you will, I'll fill you in if you come and see me. Right. So what have I got on this week's podcast? Now, we did a lot about investing in the last couple of weeks and people have really enjoyed that because the market is all over the place at the moment. We've had such a great run in stock markets over the last few years with very few corrections, and now we've suddenly hit October, the scariest month of the year, Halloween and everything like that, and suddenly the market has tanked. Now, in between that, we've been bouncing around, we've had some rallies, we've had some falls, but where is the market now? The last couple of weeks, we've been doing pieces around trying to explain what's going on, and I want to sort of update you a bit, not necessarily on what's going on in the market, but the concept of a bull and bear market. Are we heading into a bear market is one question I've been talking about in the last couple of weeks, and you're going to hear about bull and bear markets a lot. So what is it? What are they? And how do you know if you go from one to the other? Because one, which is, you can probably guess, the bear market, is bad for investors generally, especially if you're in stocks. Now, on top of that, I want to talk about something that I know we've definitely never covered on the podcast, which is the yield curve. You'll sometimes hear people talk about yield curve, an inverted yield curve. It's a herald of doom in terms of the economy. Now, what does it mean? And it's something you'll see in the paper, so I want to explain it, because people don't often explain it. The other couple of pieces I want to do, one's around debt and mortgages. If you are wanting to get a mortgage in the future and you've got a lot of credit card debt, you'll want to listen to this piece. And finally, on Monday, we've got the budget of 2018. So we're going to have some surprises probably. But I'm going to do a quick piece on what people are thinking is going to be announced in there. So we'll know come Monday what the answer is, but a bit of fun and a bit of predictions just so people know. Right, bull and bear markets. Now, I'm principally talking about stock markets because you can actually get bull and bear markets in pretty much any asset type. What the idea of a bull and bear market is to describe certain characteristics of a particular movement in an asset price. So we're going to stick with stocks at the moment for this piece. So the name bull and bear, lots of theories how each got its name, but a bull market is all you need to know is it's a market that's heading upwards with an upward trend, and a bear market is one that's heading downwards. So what does each look like? Now, they've got probably three characteristics that are the best way to describe the differences. Now, if you think about supply and demand, so in the stock market, people wanting to buy stocks and equities and people wanting to sell them. In a bull market, which is what we've really enjoyed since the QE came around, since the central bank started pumping the world full of printed money and lowering interest rates, that has happened since 2009. So we've been in a bull market for the best part of 10 years. And that means that stock markets prices have been going upwards. Just go and get your phone, open the stocks app on your phone now, and go back, click on one of the stock market indices. You'll have the S&P on there. You'll probably have the FTSE by default. Click on one of them and go back and expand the time horizon, and you'll see that it's almost a straight line going upwards. That's a bull market. It's been a strong one. And in that environment, people tend to want to take on risk, and so therefore they're more buyers than sellers. That's supply and demand metric. And you get something called buy the dip, or sometimes you get an F word thrown in there to just give it emphasis. But buy the dip is the idea that as soon as the market tails off, you buy it because it's going to rebound, because the upward trajectory remains. Conversely, a bear market is the opposite. You tend to get sellers start to drive the market. They're the ones who are making market moves. So your sellers will start putting more pressure on the buyers. So the sellers will come in, and every time there's a rally, then the overall trend of the market may be downwards. You can get rallies in these bear markets. As the market maybe picks up, the sellers will come in and they will sell, and they'll push the market down again. And we've seen in this week, I'm not saying we're in a bear market yet, but if you look at the market, get your app out again, the stocks app, look at some of the moves over October. You've had some big moves down, then you'll get a really strong rebound, and then it sells again. Those sorts of characteristics which you get extended over a long period of time in bear markets. You can get some incredible rallies in bear markets, because some of the strongest rallies are in fact in bear markets, but it's because of this rebound. Some people call it a dead cat bounce, slightly unfortunate term. Even dead cats do bounce if they fall, and the idea being that sometimes that's a bit of a trap. But a bear market, the general trend will be heading downwards. And if you go back again in your stock app and you look at after the dot-com bubble burst until the early 2000s, you can see these trends playing out over a number of years where we had bear markets. This bull market, like I said, started back in 2007. The other metric which I've touched upon is investor psychology. It's slightly different in each. In a bull market, it's very aggressive, bullish as they would call it, where they're trying to buy the dips and push prices up. The psychology in a bear market is more cautious, more defensive, because they're trying not to lose money. Bear markets, investors generally are worried about missing out on profits. And there's another thing that's connected. The stock market and the economy aren't synced exactly. One is not a measure of the other, because one is a measure of how stock prices move. And economics and economies, there can be a lag between the two. But generally speaking, bull markets tend to occur when the economy is in a growth phase, when it's picking up. A bear market, conversely, is usually associated with slightly weaker economic conditions. So you can see just take America, as their economy has picked up, the bull market has gathered strength. But of course we've got to October now and things have started to stutter. And there are a lot of people out there, and if you look at the charts, and when I talked about the key indicators last week in terms of where the market could move, there was 2,700 on the S&P 500. That was breached this week. And there's been a lot of things that have been going on in the market to suggest that the chance of us entering a bear market now, that the bull run is finally over, are much, much higher than they have been in more recent corrections like we had in the spring. So that's not to say we're there, but the warning signs are starting to flash. So if we think about what the warning signs in this transition, lots of people have lots of different indicators, and the problem is you don't know whether you've gone from a bull market to a bear market until it's happened, and it's normally way off back in the rearview mirror, at which point portfolios have been punished and money has been lost. So each different environment favours different types of investment strategies, which I will come on to in a minute. But to give you an idea, Bank of America, now they've done some research, and like a lot of these investment banks, they have their own bespoke in-house analysts and come up with indicators to say, yeah, I think we're in a bear market or we're going into a bear market, because then they can try and reposition. Now, Bank of America have 19 indicators, and they've just recently said that 14 of the 19 indicators are flashing, that we're basically we're hitting a market top and we could be going into a bull market. Now, it isn't a case that every bear market that's occurred has had these indicators all light up. So those full 19 indicators are indicating that we would go from a bull to a bear market. Not all of those indicators have been flashing in the past when we've done it. In fact, out of the last 7 bull market peaks where we then gone into a bear market, out of the last 7, only on 4 occasions have all 19 light bulbs. Think of it like a dashboard in a nuclear power station where all the lights are pinging, and once you get to 19, you've gone nuclear. It's a complete meltdown. That's only occurred on 4 of the occasions, but on the others, the majority of indicators have actually started to flash and to say, look, I think we've hit the top. We're getting there now on their metrics, but we haven't seen a few more key ones like just yet. And I'll give you an idea of one of the indicators, for example. One of the indicators is the VIX, the Fear Index, VIX, which is basically a measure of volatility on the American stock market, the S&P 500. And if you think about that sort of skittishness, that bouncing up and down, it measures the movements on that and the market participants' reactions in terms of what they're trying to do about it. So you think about that measure of volatility. As fear spikes, this number goes up. And historically, that number has been around about 20. In the last few years, we've been getting down to levels of like 10, 11. I mean, it's historically low. And that's because markets they've been artificially suppressed by all the money printing and low interest rates and all the other interventions by central banks around the world. So it's almost like a fudged market. It's almost like they've put the market into a bit of a coma. Now, we've got to the point where that VIX has started to pick up. And one of their indicators is the VIX has to get above that 20 average, that long-term average. And we've just got there, actually. We've just gone above it. And we're at the time I'm recording this podcast, about 25 to 27. Now, that's not extreme, but it is above average, and it's a pickup. So that light bulb would have pinged on their dashboard to say that, yeah, that's another indicator that's showing all's not well. Because don't forget that you need a lot of fear. Normally, a lot of fear starts to suggest that markets are turning and there's a bottom maybe playing out potentially as well. So you need a spike in fear to get some sort of transition going on. And that they've just noticed that these things occur alongside these transitional periods. But one of them that hasn't lit yet is the yield curve inverted. So the yield curve inverted, what is that? And this is something I've been wanting to talk about for a while because it's a little bit out there, but bear with me. But it's something that you're going to hear more and more about as we head into 2019. Now, you remember that we talk about bonds, particularly gilts, so they're effectively loans from the government. So an investment with a steady return over a period of time. And you're paid effectively an interest rate, a coupon, maybe every year for the risk you're taking by lending that money. So in America, they have US Treasuries. We have gilts. They're our equivalent over in the UK. And now these things are backed by the government, so they're fundamentally secure. So you're lending money to each respective government. If you take different treasuries, for example, so these are the US Treasuries. If you were to plot on a graph, imagine it in your head. So along the bottom axis, you've got the duration of the investment you're going to do. So 1 year, 2 year, 3 year, 10 year, 30 year. So that's how long you're going to give your money to the US government for. In effect, and you're going to get a yield. So that's the interest rate that you're going to get back. Now, if you visualize that, if the quality is always going to be the same because it's the same lender, imagine that down the lower end, you're going to get a lower interest rate because you're taking less risk because you're going to get your money and your capital back. If you only lend it for 2 years, you're going to get a couple of interest payments and then your money back. So you're much more likely to get it back. So you're going to not be rewarded with such a high yield. If you lend for longer, you're going to have a higher yield from your investment because they've got to basically entice you to do it. So if you think of that curve, it's going to slope from bottom left and it's going to slowly curve to top right. So it's going to be like a sort of a steady incline. So that is what the graph would look like if everything was okay in the economy. Now, what can happen is because you don't lend your money to the government for the whole period of time. You can trade these things, so they can be traded around in the market. So even if you hold it, you could sell it tomorrow to somebody else so no one person generally holds them forever. But what can happen is the going rate, the yield that's going to be, because as you sell them and buy them, it impacts what the yield is going to be on that graph. Don't worry about how that works. It will just do it because people buy at different prices. What it means is that you can get a scenario that the yield curve can change shape. So if, for example, something was a little bit untoward and people were starting to get worried about lending, then the yield curve, say they think something's going to go a bit wrong sooner, the yield on the nearer end, so 1 or 2 years, will start to rise. But then what will happen at the other end is what's interesting, because in a period where you could think that the economy is going to go bust, so think about this, the economy is going to not do very well, nearly everything is going to start to struggle, stocks are going to struggle, you're probably going to want to start holding things for the longer term. And so what that means, the safest thing, which is going to be something like treasuries. As people buy that, the yield drops at the longer end. Just think it's supply and demand. But what it means is the risks nearer term are going to start to go up, and so the interest rate starts to rise on this curve down the short end. So if you're borrowing money, lending money for 1 or 2 years, you're going to want a little bit more interest for your money. And what it means is that the yield curve starts to change shape. So it goes from top left on your imaginary chart to bottom right, because the rate of interest you'll get for lending to the government in the short term is higher than it is over the long term, and that is unusual. Even you could think about that. Why would that be? And one of the reasons could be that we're seeing possibly now is that the central banks are hell-bent on, in America, hell-bent on raising interest rates, the short-term interest rates quickly. So they're thinking that the economy's overheating, so they're starting to raise interest rates. And that would impact the lower end, because if interest rates that the Federal Reserve are raising are going up, then that means the short-term interest rates on the treasuries will have to sort of match that, because otherwise why would people buy them? So that starts to rise. But, of course, that could rise above where the long-term yield is. So that's why you start getting it to invert. And, of course, if you think about that, that can start to herald. It is seen as an indicator, and it has been a leading indicator of a recession. So an impeding recession. So as we're booming and the Federal Reserve will start to raise interest rates in America, they may be raising them to a point where people are thinking, well, actually the long-term outlook isn't that great. And the yield curve starts, if it steepens, it starts to show that investors, the smart money out there, are starting to bank on the fact that actually the economy is going to probably start to slow, because they are starting to buy longer term bonds, holding bonds from the US Treasury for longer than the short term ones. That's very, very unusual. So it's normally, all you've got to worry about is this idea that the yield curve inverting can herald an economic recession. And of course, if you get an economic recession, the chances of a bear market are that much higher. Now, if we look at other indicators, you might think that, well, everything's booming, why would we suddenly get a recession? Interestingly, if you go back in America to 1940, as far as 1948, and look at the employment numbers that are out there, so how many people are unemployed. Now, that figure has been going down and down and down. And if you get in a business cycle, so a period like we've had now, we've had an expansion, then the very lowest rate you start to see, where we almost get into the point where employment is maybe not full employment, but it's actually getting to the point where unemployment is at a low, that often precedes a recession by 9 months and a bear market by 15 months. So it's almost like you suddenly hit the peak and then it falls apart. And the problem is with economic indicators, they're normally lagging, so you find out what things were doing after the event, but you end up finding all this stuff suddenly catches up with you in a sort of car crash scenario, because we're looking at the rear view mirror. So why this is interesting is because earlier on in this year, we had unemployment levels fall to lows in this business cycle. So that would then start to suggest that we're going to have a recession probably soon anyway, and a bear market within perhaps the next year. The problem is you just don't know when it's going to occur. So these are things that are indicators, they're not cause and effect. So what Bank of America are doing, again, well, the yield curve hasn't inverted yet, so I don't think we're going to get recession just yet. Whereas you get other people who might be looking at other indicators, like the one I said, are going, well, I don't know, I think the recession may be coming. Point is that there is a good chance that there could be a recession next year, and that's what the economists are worried about, and that's what the smart money is now trying to look at. I say smart, it's just the institutional money. So that's where we are at the moment, and that's why we could be transitioning now from a bull market to a bear market. And we could actually be entering a period of consolidation. That could be doing the same, where people are trying to adjust to this new world of maybe slower economic growth, interest rates going up. But if we are transitioning from a bull market to a bear market, we won't know till after the event what works in each environment. Now, we know what works in a bull market. You basically go look at what went up in September or in the summer. That's what works in a bull market. We're talking tech stocks, the things that people are euphoric about, the stuff that people are really crowded into. That was the stuff that would work well. In a bear market, that's the stuff exactly that doesn't work well, and it starts to unwind. The things people will buy are bonds and treasuries, but the high quality ones, the ones that are normally issued by governments, because in a recession you could have a company go bust, so if you're holding their bonds, that isn't necessarily a good thing. But a government is, if it's the UK or the US, it's unlikely to go bust. That means that if you look at the other things that might work well, blue chip stocks, what they mean is things that are slightly defensively positioned. So they're stocks that maybe provide things that people buy in economic recessions no matter what. Unfortunately, that means cigarettes. That means medicines. That means normally healthcare. So those things will be bought, utilities, no matter what happens in a recession, because they're things that people need to live. The discretionary stuff out there then starts to get hit. So that means you'll probably see equity incomes fare better than normal vanilla equity funds. That doesn't mean they'll go up. They'll probably just do better. They may just lose less. In bonds, like I said, the risks are there if you go for company bonds, but especially high yield ones. The higher the yield, the higher the risk. So therefore they might actually blow up. But cash is obviously a good position. And we're obviously talking about a bear market in stocks. So hopefully you can see there that where we are at the moment, and it's giving you a bit of context, we're trying to work out if we're going into a bear market. And 80/20 investor members will read this week's newsletter. And I talk about what's been going on. And there is a bit of it feels like a battle between the bulls and the bears. A vicious battle that we're just hopefully trying to work out who's going to win. And it could be a bit of a winner-takes-all scenario, and we could start to be in a bear market. And as I pointed out last week, there are loads of markets that are in bear markets already, or very close, and they include European markets. And I explain in my newsletter this week why a particular European stock market that is almost in a bear market territory, why that's very important for more globally. So we are at the position where we might be entering a bear market, we're not sure, but those are the indicators. Look out for news about this inverted yield curve. Don't worry too much what it means, but if people are talking about it, if it occurs, it could start to mean we're going to go through a transitional period. And if that transitional period ends up turning into a full-blown bear market, then it's the case of looking at those things that might work well, something we can come back to, and perhaps reducing risk. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show. Okay, so the next piece I wanted to do was about mortgage and debt. It's a very popular topic, funnily enough, about how you can get a mortgage if you have some debt. And there's a particular piece relating to somebody who had £25,000 worth of debt. So just to give you a very quick example, somebody who's got £25,000 worth of debt, which equated to about 90% of their credit limit, was trying to work out whether they could actually still get a mortgage. They had decent income, they'd never missed a payment, they had a partner who had a very good credit record and no debt. So is it possible in those scenarios to get a mortgage? Now, the key is, when it comes to having debt, if you can pay your mortgage, your debt, you'll pay your mortgage off, that'd be the day. Pay your debt, credit card debt off each month in full. It shows you've got a handle on it, even if you've got or using your credit cards, and that's therefore a positive. If you can't, which is what most people are like, they can't, then if that amount is less than 25%, then generally speaking, and when I say less than 25% of your overall available credit across the board on your credit cards, then that's a positive from lenders' perspective. Different lenders may have different criteria, but that's a ballpark that you can run with. Then that would mean that you wouldn't be stopped from getting a mortgage. Of course, this person who had 90%, that's going to prove quite difficult. In fact, it's probably going to prove almost impossible without some form of specialist lender. Now, it was funny because the last couple of weeks we talked about people who had joint mortgages and joint accounts and all things like that, about having people's names on the bill. And I had an email from somebody saying, is there ever a scenario where having some sort of tie-up actually is beneficial? Now, this question that the topic I'm talking about now, actually presents an example where it can be slightly beneficial for people to be connected in some way financially. Now, if this person who they were wanting to get a mortgage on their own, which I should have made clear at the beginning, they wanted to get a mortgage on their own. They weren't trying to involve their partner because they didn't want to wreck their credit score. So that was the reason they wouldn't be able to get it on their own. The fact is, they wouldn't wreck their partner's credit score if they were to apply for a mortgage and get a mortgage together, because the credit scores are what they are. They're independent, but they become financially connected. So it would impact the partner's ability to get credit, because they would actually see, if she went to try and get a loan, that she was connected to her partner who had a terrible credit rating and credit record. But it can be on occasion that if they go and get a mortgage together, then they may be more likely to actually secure the mortgage, because the debt payaways, the debt payments that they're paying each month versus the household income would be smaller. And that can be a criteria that lenders use. So it could actually mean they may have a better chance of securing the mortgage. Of course, it's a case of that the partner has to be happy with the fact they're going to be financially connected. If it's their dream, then they may be happy to do that. The moral to this is, though, if you are unsure, you should always speak to a mortgage broker, an independent mortgage broker, who can advise you on what's the best thing to do, taking account of all scenarios. Because sometimes the view that you may have, you want to go it alone for whatever reason, because you don't want to impact your partner, may not necessarily be the best. But generally speaking, being financially connected will benefit the person who's got the terrible credit rating. Okay, so just to wrap this one up, I want to do a few budget predictions. Now, it's the budget on Monday. By the time some of you may have listened to this, you may already know what the budget is, and we'll cover it next week and what it all means, what Philip Hammond announces. Now, I've run through a few predictions. Some of these are going to be well wide of the mark. It's just something, a line in the sand, so people can see what were people expecting and what they eventually get when we talk about it next week. Now, the fuel duty freeze, that's already been announced by Theresa May in the Conservative Party conference. So we know that fuel duty isn't going to go up. If it does, that would be a surprise. One of the things that may happen is they may scrap the increase to the threshold at which 40% tax is paid. So it means that more people will start paying 40% tax. That was something I think the Conservatives promised in their manifesto. So that may now not happen. If you're a small business owner, there's rumours that they may go after small business owners. Don't like the idea of it, but I like the sound of it. A VAT attack. What they were rumoured to maybe be doing is reducing the level, the threshold of which your turnover is assessed, from £85,000, at which point you then start paying VAT. They'll drop that to 43,000. So it means they'll get more people be hit by VAT. The other ones will relate to pension. Now, every time we do this podcast, every time I have a cover a budget since I've been in finance. It's always, they're going to scrap pension tax relief. They're going to attack pension tax relief, and they never do. And I think there's a lot of people who've got a lot of interest for it not to happen, particularly pension providers who put a lot of pressure on the various politicians and especially the Chancellor. But again, rumours that they may lower the tax relief that you get on pension contributions, and they may actually cut the tax-free annual allowance that you can have, so the amount you can put into pensions. We shall see what happens. I mean, I've heard this many times before, but nothing does. The last two quick ones are plastic tax. They probably may do something around trying to reduce the amount of plastic that's used in packaging, straws, etc. by making it some either financial incentive for companies to be more environmentally aware or somehow penalising. And the last one is, I think, was more of a wish list. I don't see it happening, but an everything ISA. We've got stocks and shares ISAs, cash ISAs, help to buy ISAs, innovative finance ISAs, you name it, there's an ISA for it. The problem is that ISAs were very, very popular because they were originally quite simple and they were very successful at getting people to save. The problem is now is that they're so complex, and the number of times I get asked, should I have this type of ISA or that type of ISA, and I think it's actually putting people off. So the people who provide ISAs or who provide advice would love to see the whole system simplified. Now, we don't have a great record of simplifying anything. I mean, pension was the last one that they did actually do something fairly successfully, but it's also caused a fair few problems. So I won't hold my breath on that. So that is it for this week. Don't turn off. Remember, come visit me and Andy at the pub for a beer and a chat on Friday, 6 p.m. at the Cross Keys pub in the City of London, just on Gracechurch Street near Liverpool Street and Bank Station. Go on our Facebook page to find details and follow me on Twitter so you can get any more updates around it. But please do leave us a review. It's great if you leave us reviews. We will try and read them all out as and when we can. And hopefully, Andy will be back again next week and you'll have both of us on the show. And so not until next week, but rather I will see you on Friday.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.